April 17th, 2025 regular meeting of the Conejo Recreation Park District Board of Directors. Welcome. And I'm going to lead us in our flag salute. If you would please join me. Ready? Begin.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you very much. If our clerk would please call the roll.
Director Nichols?
Yes.
Director Cussworth? Director Huffer?
Yes.
Director Buss?
Yes.
Director Orozco?
Yes.
Thank you. And next is special presentations. And we have a special presentation this evening, and I see it's our Parks Specialty Unit in Contracts. So
Thank you, Chair Nichols.
I understand we are not having a demonstration, but we are having a presentation.
Yes.
Okay, let's go.
I'd like to introduce Patrick Belovic. He is 4 weeks in, right, Patrick, as the new park superintendent. Patrick's been with the district for almost 10 years as a ground supervisor. So he's taken on the role with Matt Kuba retiring, and Patrick's 4 weeks in, like I mentioned, and he will be introducing Mike Byrne.
So first of all, I want to thank Andrew very much for giving me the opportunity to fill that role. I'm super excited. I'm super excited for the future of our district and our new team that we've currently put together. A lot of changes that have happened. I'd like to introduce Mike Byrne. Mike has been in the landscape industry for over 35 years. We swept Mike away from Pacific Sod. He was the crewman or crew leader, foreman for Pacific Sod, and he installed the sod at several of our parks over the last 10 plus years. Mike came in as a crew leader for CRPD. He spent 8 years in that position. And then he spent the last year as our projects contract supervisor. And he's here tonight to tell you what that job's all about. Mike?
Good evening, ladies and gentlemen. Thank you, Patrick. Again, my name is Mike Byrne. I'm the supervisor of the contracts and projects. And essentially, my duties are to ensure that our vendors meet their contractual obligations that support the improvement and the safety of our parks and facilities. This evening, I will be discussing the contracts that I oversee. These contracts include landscape and custodial services, concrete, fencing, and asphalt repairs. And then I also supervise 3 CRPD, which employees, what we like to call them, our specialists. They are our equipment operator, our irrigation auditor, and our pest control technician. Our largest contract that we have is our landscape services contract. We went into contract with Natural Green in 2023 for a 5-year contract with an annual budget of $730,000. So what do they do? Well, we have 47 parks that need mowing and edging, and they service all 47 of those parks. Of those 47 parks, we have 17 full contract parks. Well, what is a full contract park? A full contract park is a neighborhood park which requires more services. For example, emptying trash, picking up ground trash, weed abatement, cleaning barbecues and tables, raking the 5R in the playgrounds, pruning trees and shrubs, and rodent control. So our next large contract is our custodial contract. Again, like Natural Green, we went into a contract in 2023 with EFS. with an annual budget of $448,000. What do? Well, we have 13 parks and facilities that are serviced 7 days a week. They service offices, restrooms, classrooms, they sweep, they vacuum, and they mop the floors. There's also specialized cleaning that they do once a month, a couple of times a year, quarterly, stuff like that. Deep cleaning the stoves and polishing the linoleum floors. So the next 3 areas of contracts I oversee are on an as-needed basis. Thank you. First of which is our concrete repairs. We have an annual budget of $100,000 for our concrete repairs. With acres and acres of concrete walkways, paths, patios, it's inevitable that the concrete is going to be compromised at one time or another. So some things to consider is our safety, our compliance, and our aesthetics. And with annual costs in the last 3 to 5 years have nearly doubled, so it's challenging to keep with the demand while managing a tight budget. Fortunately, we hire very respectable contractors, and they're all local. So the next area of repairs is our fence repairs. We have an annual budget of fence repair, which is $110,000. And we have new fencing with an annual budget of $12,000. Like concrete, we have miles and miles of fencing. Inevitably, there will be damage either by accident or by design. So we need to be cognizant of safety, compliance, and the repairs need to be complete as soon as possible. And again, like concrete, we are very fortunate to have several contractors who do great work. So our next is our asphalt repairs. Over the last year or so, we've been working on smaller repairs, but we are excited to begin larger and more significant capital improvement projects in the upcoming months. In addition to managing contracts, I also supervise 3 CRPD employees, like I'd mentioned before. Which consists of our equipment operator, our irrigation auditor, and our pest control technician. Our first specialist is our equipment operator. Andy has been with us now for about just over a year now, and his job is to operate all our, all our heavy equipment to support the grounds, building maintenance, recreation, and COSCA. Andy assists with mainline irrigation breaks, weed abatement, planting large trees. He does grading work. And one of the key benefits of having Andy is having him able to respond very quickly, as opposed to us outsourcing some kind of heavy equipment operator. Our next specialist is our irrigation technician. Joe Dodge has been with us for about 10 years now, and he's a valuable asset. He ensures that the irrigation systems are working as they're designed to do. He develops irrigation schedules and plans with the crew leaders and with the supervisors. He also identifies opportunities to improve our water efficiency and usage. So matter of fact, since 2008, CRPD has reduced water by 52%. In that same time period, we have saved over 1 billion gallons of water. Much of that success is due to Joe's efforts. Our third specialist is our pest control technician. From ants and bees and spiders to rodents, Tony, who's been with us for almost 20 years now, identifies the problems and determines a treatment plan. Tony also assists with over 20 annual park refurbishments with herbicide applications. As with everything else, herbicide costs have increased significantly. So a typical refurb spray application will run about $5,000 per refurb. So in addition to what I manage, I also partner up with other supervisors, okay, on shared projects. These are larger projects and CIPs, which may require fellow supervisors. We pull pool all our resources together, and we work together with multiple contractors at times. For examples, we're excited that we're going to be working with the contractors for the skate park. And then we have plans for larger parking lot CIPs. So with that, thank you very much. Is there any questions?
Thank you, Mike. I think we have some very specialized questions for you too, with all that. I'll start with Director Huffer first.
You know, we regularly get compliments from the folks who are using our parks and facilities, and I suspect most of them don't realize what it takes to keep the grass mowed and green, to keep the sidewalks safe, to keep everything watered properly. So what you do with a fairly small staff of specialists with the contracts is pretty incredible and certainly appreciated by us, even if the public isn't quite aware of what's going on. So
Thank you.
I really do appreciate everything that you and your staff do. I did have just a couple of questions. I tend to spend a fair amount of time over at Conejo Creek South,
Mhm.
particularly the last few months. And I'm just curious, it seems to me in years past that when they came out for their weekly mowing, they had this great big huge mower that zipped right through it. And then it seems to me in recent months or maybe the past year or so that they are using the smaller riding mowers, but I'm just curious as to you know, it appears from a person who occasionally will pull out a hand mower, but just wondering, seems like it takes a lot of time for the smaller machines to mow that huge area.
Sure. It's a good question. When we went into the contract with Natural Green, we just assumed that they would be using the big drop mowers. Well, they don't. And that's what, you know, as far as efficiency, it's probably not the best. It's a challenge that we face. And I don't know what the answer is. I mean, the grass is cut the way it's supposed to be, but sure, I don't think it's efficient at all.
Okay, well, presumably they're not charging us more for
No.
taking more time
No,
to use the smaller machines. I was just sort of curious because notice the change there.
that's a good question.
The other question I had, your pesticide or pest control specialist.
Mhm.
I know some years ago, there was a fairly significant issue with concerns about what was the,
Glyphosate?
yeah, Roundup.
Glyphosate.
Roundup. Yeah, Roundup. And I know, at least my understanding is we've discontinued
do not-
using that altogether.
That is correct.
The pesticides that we do use have been thoroughly vetted and
Yes.
completely safe.
Yes, in compliance, yes. And to substitute for Roundup, we use a product called Lifeline, and it has all the things that we don't want.
Okay. Again, thank you very much for
Uh-huh.
everything that you and your specialized staff do
Sure.
for the district.
Thank you. Director Buss?
I have a couple questions. I don't know if, well, I think you'll be able to answer them, or maybe Melissa will be able to answer them too. But so I'm curious on the contracts. Are they mostly hourly, or is it like a flat rate project type bid?
So, a good question. So, the contracts, we take them out for bid, you know, this particular contracts began in 2023, right before my time in this position. So during the RFPs, we accepted their bids, and whatever that bid is, and the one that we accepted, that's where it stays. There's no hourly on top of that. Now, our custodial contract's a little bit different. They have the opportunity to use an addendum once per year and either increase or not. And so as far as those two larger contracts, those are only, EFS is the only one that could really change things.
Do they usually change things once a year?
Well, okay, so we went in it, in 2023, so I believe, I know they have at least once.
Okay.
And I looked it up and it was a 3 to 4, 5% increase, from 23 to 24. They have not submitted anything at this year. They
Okay.
have till the end of June.
I was just curious on those, like if it was like an hourly, like they bill us for hours or what?
They bill us on a monthly, invoicing.
Yeah, just to jump
Okay.
in, Director Bus, we have a flat rate per month per park facility, depending on what services they're providing, and that
Okay.
goes for landscape as well as custodial. And then like, as Mike said, we're in, conversations with them over time, because just like our expenses go up, their expenses go up. So that's kind of reviewed on an annual basis with the contract.
Oh, okay. And then just curious, so is it just too much for us to handle hiring our own employees for these positions for janitorial and landscape?
So
Is just better to
it's a,
outsource this?
yeah, it's a balance of service through our full-time staff as well as with our contract staff, just like we have skilled staff that could build a park per se, right? But they're maintaining existing facilities, doing other work. And so as Mike mentioned, the bulk of the landscape contract is for mowing services. Way back before my time, and maybe 20 years, Jim, we used to have a mowing crew. And so we just had a handful of full-time folks. And so in review, we felt we could give a better service by using those full-time folks doing more specialty detail work
Mhm.
versus using the contract to be able to provide a more broad service. Similar to kind of our custodial, a lot of times, or not a lot of times, most of the time, the services are being done at night. Rochelle's folks are having fun with the public, doing tons of programming during the day. And so how do you clean it if there's people
Right.
using it? And so our contract is, they come in after hours, late hours, which is kind of typical in the custodial trade to be able to service, especially the centers.
Yeah.
And then the restrooms, that they're on a kind of a different clock depending on, their route and service for it. So depending on the time of day and timing with the workload. So
Yeah,
Yeah.
so for us, it's just easier to not have to manage that many employees and then on top of it all, the expenses that come with employees. It's just better to, like, cost savings wise and management. to
correct.
use-
Yeah, we feel we give a better product with using our full-time employees to do more detailed specialty work, and then the
Yeah.
broad, more labor type work like mowing and custodial is handled through the contracts. But we do have we have 2 custodial staff.
Yeah,
And then obviously we do have mowers to mow some of our specialty sites and things like that. So it doesn't completely go away, but again, it's the bulk of that labor type stuff.
right. And then I was just curious for the large equipment, do we own all of that or do we have to rent? And then he operates, Andy was his name. I
Oh,
believe.
Andy, yeah,
And then he operates it or do we own it all?
we own it,
Oh, okay.
yes.
Cool.
There is an occasional rental
Mhm.
of maybe
Something.
a piece of equipment that we don't own, that we need on occasion.
Okay.
Mhm.
I was just curious about that. Cool. Thank you so much for your presentation. It was very informative.
Thank you, Director Orozco.
Thank you, Chair. I don't really have too many questions. I think my fellow board members have asked all my questions and you skillfully answered them. So thank you so much for the informative presentation.
Oh, thank you very much.
I do have a couple of questions for you on the theme of Andy, the heavy equipment operator.
Mhm.
With only one operator, there's
Yeah.
only so much heavy equipment that can be operated at one time, which would be one. So I would imagine that he's not doing some major projects. He's kind of doing some things that need to be done on a timely basis, that you don't need to let a contract out to do some major work. He's just kind of helping to keep things moving. So kind of where do you draw that line? Is, what's something that you would ask him to do as opposed to, okay, no, this is something more, we need to contract this out?
Well, I can say that most of our work, I can't give a percentage, but it's a high percentage that he does all of it. All right, there are times when we need to bring in a contractor and and to use them for grading or maybe, crane work or something like that. But mostly Andy takes care of it all.
Okay.
He really
Very good.
does.
Can you speak to the microphone just because this is recorded? We
Oh.
just want to make sure we get all the
I
details.
do want to add that several of our employees are trained in equipment operating as well. So we have guys that could run a skip loader or a excavator as well. Andy just does kind of the bigger work we could do without hiring a contractor to do it.
Okay. Oh, super. All right. And then I know we talked a little about the mowing contract and
Mhm.
we still have some mowers in sheds somewhere to do mowing. So how is that a regular thing where we still have staff that does regular mowing, or is this like on an as needed basis?
Okay.
Special event or something, or you need to
So,
have someone go take a
good
look at it?
question. So we do, we have I believe, 2 ride-on mowers. A single blade on both sides, on the Borchard side and the OSY side. And a lot of times during our refurbishments, we have our turf refurbishments are fenced in.
Mhm.
So after a few weeks during the refurb, a lot of our crew leaders, we like to mow our own grass until those fences go down.
Mhm.
So after that happens, then the contractors come in and resume their duties. But every now and then they're used. Yeah.
Okay.
So again, like we have over 20 turf refurbishments per year.
Sure. Okay.
So it helps because sometimes it could be cumbersome for the contractors. They may not have a key to get into the gate for the inside the refurb fence. And so, we handle our own mowing up until that refurb is complete.
Okay. And then of the 47 parks that are maintained,
Yes.
17 of which are
Our-
full
Our
contract for the
full
whole park.
contract parks, yes.
How does a park get into that full contract mode? Or what does it take to step up like that?
Okay, well, that happened before my time, so I'm gonna hand that off to Andrew. Thank you.
Sure. So the majority of our full contract parks are our neighborhood parks. So it's based on proximity to our yards. So they're a little bit further out. They might not be as accessible, right? And then we do have full-time staff at our 6 play fields as well as our 6 community parks. And so it's a balance of the level of use that's happening, not to say that neighborhood parks aren't being used, but then those that are either smaller in acreage, less demand from the public from a use standpoint. But then again, back to like proximity to get from staff to have to travel to get there on a routine basis, because it may pull them away. The crew, we have 5 different grounds crews throughout. 2 on the west side at Borchard, 3 over at OSY on the east side. And so it's from an efficiency and just productivity. That's how we've handled the contract in over the years. So.
Okay, very good. And then one final question. This is something you didn't mention, but when you're talking about custodial contract, having periodic deep cleaning or, waxing floors or whatever it is, it made me think of gym floors. And I was wondering, is that part of their routine, or
Yes.
is gym floor a real specialty that has to be done with somebody else?
Well, all I know is, not all I know, what happens, it hasn't happened in my tenure yet, but I believe the gym floors are serviced once per year. And I believe EFS, our contractor, handles that. And they provide, whatever that service or specialty service is, they provide it for us.
Okay. And is that, more than just a cleaning? Is that like a refinishing
Yeah, they have to
process?
strip and refinish.
Okay.
Mhm.
All right. So I know I just was thinking of all the different types of maintenance that's be done. I thought it was hard to keep my house in order, but all the things that you guys have to contend with, is amazing. So thank you for the presentation and the enlightenment, and sounds like you're able to keep track of things in a miraculous way. So thank you for doing all that. Patrick, thank you as well. And again, congratulations
thank
on
you.
your new assignment, and thank you both.
Okay.
Yes, Director Huffer?
I just wanted to take a moment to publicly thank Patrick. I think he'd been on the job for a week or two and got faced with a major plumbing problem over at Conejo Creek South. I guess some of it's still being worked on the north end there, but appreciate what you and your crew did in making sure that we continue to run the tax program 5 days a week without any major disruptions. So thank you very much.
Thank you. And you're welcome to stay for the entirety of the program this evening, but you're also welcome to leave. It's up to you. But thank you for being here this evening.
Riveting.
Thanks, you guys.
Thank-
Okay, next is items from the public. I do not have any cards. Do we have anyone waiting online? No. Okay, thank you. Next is approval of the agenda. If we have any requests to change the agenda, and if not, a motion to approve.
I'll make a motion to approve the agenda as is.
Thank
I'll
you.
second.
Have a second. All those in favor say aye. Aye. Any opposed? Thank you. That passes. Next is our consent calendar with the minutes and the warrants. If there are any modifications, edits, or otherwise, and if not, a motion to approve.
I'll move approval of consent item A, approval of minutes, and B, approval of warrants.
Thank
I'll
you.
second.
And we have a second. All those in favor say aye.
Aye.
Any opposed? Thank you. That carries. Next, deferred matters. Would our clerk please read that into the record for her deferred matter?
Public hearing, preliminary budget, fiscal years 2025 and 26 to 2026-27.
Thank you. This is a public hearing, so I'm going to open our public hearing. I do not have any cards for any public speakers. Do we have anybody online wishing to speak to this by chance? Okay, we do not. I'm going to close the public hearing. And we are moving forward. Next, items for discussion. And I'll ask our clerk to read this item into the record, please.
Conejo Recreation and Park District's Long-Term Liabilities Investment Performance Update by Schuster Advisory Group, CRPD's Trust Administrator and Investment Advisor.
Thank you very much. And I see with our staff report that Ms. Smith is going to be handling this. If you care to brief us on your report.
Yes, thank you. So I'll give a brief summary. I don't want to steal too much of Mark's thunder. But as you all know, the district has taken its long-term financial sustainability very seriously. We've established 3 different accounts to manage our pension and retiree health liabilities. These accounts are currently overfunded by $5 million with a 106% funded status. You can see that in the spreadsheet I included in your staff report. Back in 2022, the district transitioned from management of these funds from PARS to Schuster Advisory Group. This transition cut our advisory fees from approximately 0.67% to 0.22% and increased our average annual returns from 7.57 to 9.78. So lower fees and higher returns. So this move has obviously significantly improved our performance and our costs. And then also, given the current market volatility, we thought this would be a good time to have an update on how our investments are performing and being managed. So with that, I'll hand it over to Mark. Mark Schuster is the managing partner and CEO of Schuster Advisory Group. He has over 30 years of investment experience, and he also advises CRPD on the 457 plan for employees, and he provides these same services to the MRCA. So with that, I'll hand it over to you, Mark.
Wonderful. Thank you very much. And I also have Sarah Yahtzee on the line that runs many of these programs for us. Appreciate seeing you all again. And Ashley, it's a pleasure meeting you. I understand you're the newest director. So what we thought tonight, we would go over not only the use of the 115 trust, the defined benefit plan, but of course, obviously the market performance and most importantly, how you're allocated right now and what is going on in these volatile markets that we've all been experiencing over the last several months. And so before I get started, any initial questions that you all might want to be briefed on tonight other than our presentation?
Any questions? Mark, I think this is Doug. I think you mentioned this, but I guess I would just be curious to know if our balance is correct, and I think that's part of your intention. And with the overfunding of $5 million, if that's something that we should adjust. So you include that in your presentation. If you haven't planned for it already, appreciate it.
Absolutely. Well, first of all, I mean, as has been described by Melissa, you put together these programs to fund and meet current and future obligations. So a 115 trust, as you know, has been established as an irrevocable trust by the IRS that again allows for not only tax deferred growth inside these portfolios for future OPEB and pension stabilization, but again, these are assets that cannot be diverted back to the district to be used for anything other than those allocated disciplines. And so, like any type of future liability, you want to look at where you're funded to, how long that funding goes, and then looking at future volatility or future changes. Now, the key number that we look at is always the discount rate that your actuary has put forth for both your defined benefit plan and your OPEB. And then, of course, CalPERS has stated their discount rate or hurdle rate of 6.8. And just as a reminder, what that means, it means that they have calculated that your funding assumes you will earn 6.8%. The higher the rate of return or the hurdle rate, the less money you have to fund. In the case of your OPEB, you're funding that at a hurdle rate of 5.39. So to the overfunding of the OPEB, if we dropped that rate from 539 to 439, as an example, 100 basis points, you might be underfunded. You wouldn't be overfunded because it's assuming you'll earn that through the course of the 10, 20, 30 years that you have to pay out those obligations. The higher the rate of return, the more overfunded you would be. So it's great to be overfunded where you might use those dollars in the future for other expenses that you have, including pension stabilization. But to give you an example, Doug, we recently had a very large city that got to 98% funding of their OPEB. The decision, and they were funding $10 million a year. The decision was to no longer fund the OPEB, however, move that money into the pension stabilization to bring that funding up to a comfortable level, because we all know with pension stabilization, that liability will never go away, where your OPEB has an inevitable ending to when those benefits are paid out. And so it's something to think about as a board to determine any funding into the future, but also looking at rates of return in the future that we're going to go over in a few minutes. I wanted to go right into a summary, actually, that I think will be very helpful for the board. And if you look on the upper left-hand corner, you see your retirement plan and your 115 trust summary, and you see the retirement plan, the pension stabilization, the OPEB, and the totals on the right-hand side, ending the first quarter 3/31, and of course the number just 15 days later. As you all may remember, the tariff announcements that came out on April 2nd. And we actually have some different slides later on that will show you that just shows the effect of the volatility that has been very dramatic since March 31st. But the key numbers, as I referenced earlier, is the number, and I'm going to go down to the bottom of the page. You're going to see the retirement discount rate, that 5.39%. And you're going to see the CalPERS at 6.80 and then the OPEB at 5.39. Those numbers are important because those drive whether or not you're overfunded, underfunded, or at par. And then they inevitably drive the investment allocation on where you're investing your dollars today. And that's critical. Today, for all three programs, you are currently at a 60 equity, 40 fixed income allocation. Now, as an example, CalPERS, that is the defined benefit plan, they are at a 70% equity, 30% fixed income, because they have to hit that 6.8 rate of return to meet their obligations. And of course, to inevitably come back to the district and request the dollars required to fund your obligation for your employees. And as you can see in the annual contributions since 2022, you'll see what the dollar figures are for both the retirement, the OPEB, and the pension stabilization, and inevitably the annual distributions under the retirement plan and the OPEB. Now, I'm going to go to the next slide that really goes through the performance and the important numbers. And this goes to the far right-hand side. These are numbers that you see for the defined benefit plan. And you'll see the important dates. And we showed these 3 dates for a reason because of the volatility. 3/31, April 9th, and then of course the 15th. And if you look at the figures here, you look to the right-hand side and you look at since inception of July 19th, the portfolio has returned in 8.93% during that time frame with the benchmark at 882. But if you look at the 1-year performance, the 1-year performance is at 596, the benchmark at 464. Go down below and you look at the 4-9 dates. If you look to the right-hand side, you have dropped 100 basis points since inception because of that volatility. If you look to the right, the 1 year, it's 401. But what was interesting is look at the benchmark because of the volatility in the marketplace. Now, part of this delta, meaning you outperform the benchmark, is due to the way we reallocated portfolios on a quarterly basis and how rapidly markets were moving. Down below, you see the 415 date, the rate of return going to, on a 1-year basis, 673. And again, benchmarks moving because we saw some of the most volatile days ever in the market over a period of 1 to 2 weeks, not only the equity markets, but the bond markets. And I'm going to go to the next slide, which is your OPEB, which is again, the portfolio overfunded. And you see your rate of return since inception at 10%. Then just 9 days later, 9%, still 9%. But you look at the 1-year rate of returns of the 6, the 4, and then back to the 6. Again, enormous volatility. Now, we never like looking at rates of return over a 1 or 2 week period of time. It's never healthy to do that because this is a long game. This is a marathon, but the portfolios are performing the way they should. And we want to look at your risk going forward as all 3 portfolios are at a 60-40. So what I'd like to do at this time is look at how we look at the way you build a portfolio. And the first thing we want to look at is the capital markets assumptions. And for all of you, you've seen some of this chart before, but these are all the major asset classes in the world, from equities, fixed income, and then private markets. Private markets, as a reminder, hedge funds, private equity, private debt, private real estate. You've heard these terms before because these are all areas that CalPERS in the defined benefit world invest your dollars on behalf of your employees. We look at this, as do large institutions like ourselves, and look at these projections over a 5, 10, 20, and 30-year period of time because these obligations last that long. So you look at these projected rate of returns, and then you look at the projected volatility per that asset class, which helps us all build inevitable portfolios to perform at a level of risk that you as a board are comfortable with. And as you see, these numbers are dramatically different. But I want to share with you a couple of real key ones. One of which is the first fixed income that you see about 10 down. You see the 4.73, it's the Barclays US aggregate bond. And you look at this rate of return projected over 30 years. 4.73 to 4.23. What does this mean? It means that today economists and analysts project interest rates to stay around where they are now. They may dip during economic crises, but over the long term, that is basically your aggregate bond rate of return. And you look at the risk, 4.98, very low compared to every other asset class. But now drop below. I want you to look at the second from the bottom. This is private debt. You hear that term, private debt, and you see those rates of return at 994 all the way up to 906. And so over that 30-year period, they're looking at, if you go out and lend privately, not publicly, meaning issuing a bond, the rate of return is 9 to 906 to 994. But look at the risk, it's 12. But private equity that you hear about in different large institutions, go right up above and it says US private debt, and you see those rates of return at 10, 1, 6. It's right there we go. And go over to the right-hand side, and those might go up to 11. But look at the risk. It's 3 times higher than private debt and 8 times higher than a US public treasury. And so when we build portfolios, it is all about risk and reward inside a portfolio. So I'm now going to go to the next slide to show you what are the projected rate of returns for a 60-40, a 50-50, a 70-30. And so you see up above, you see all of your 60-40, you see the discount rate, or another term is what interest rate are we shooting for performance-wise? And then you look at portfolios down below. That first number is equities. The second number is fixed income, i.e. bonds. And if you look over that 10 to 30-year period, it's projecting a rate of return of 5.20 to 5.6. Now, what is the difference between the 3 in that category? The first one has just pure publicly liquid debt. The second one says 5% into private debt and 10% into private debt. Well, what does that mean? If you look at the middle column, the risk range, 0 to 100, using a little private debt actually de-risks the portfolio from 39 to 38. If you look to the right-hand side, this investment rate of return is the projected rate of returns based upon a 95% probability going back every 6 months for the past 15 years. What is the range a 30-70 portfolio might return? And as you can see, negative 6.7 to 11.8. About an 18.5% range between them. But because you added a little private debt, it actually de-risked the portfolio and added to return. That is why you see CalPERS investing so much money into private debt, into private equity, because they're trying to boost rates of return and de-risk the portfolio. So as you go down to the left, you see the 30-70, the 40-60, the 50-50, and the 60-40. Today, the district's portfolios are all in 60-40. The OPEB and the defined benefit plan that have a discount rate of 5.39, with the way interest rates have changed over the last 2 to 3 years, and over the last 5 years, it's dramatic. As a reminder, in 2019, 4 months before the pandemic, interest rates were 3.5, 3, they fluctuated. When March hit in 2020 in the pandemic, the Fed moved interest rates to 0. They stayed there until 2022, when, due to inflation, they moved interest rates to 5.5%. And now today, they're about 4.3%. It has been the most volatile time in interest rates ever, and it's all happened in 5 years. So taking advantage of interest rates is what we've done in the portfolio. So if you look at your portfolio today, a 40/60 can actually get you to your 539 over a 30-year period. It could not do that 5 years ago or 3 years ago because interest rates were so low. And if you own bonds, you were getting 2 to 3%, not 4 to 7%. So one would argue today on your OPEB and your defined benefit plan with a hurdle rate of 539, you could de-risk the portfolio down to 50/50 or a 40/60. On your pension stabilization, however, the hurdle rate is 6.8 because you're really hedging against CalPERS and their ability to perform. And so you look down below and say, okay, a 60/40 can probably get there, but maybe it's a 70/30, which is why CalPERS is a 70/30. Now, the issue that had happened ending 6/30 in 2024 with CalPERS is they earned 9.3. That was great. The problem is the market for a 70/30 earned about 14.5%. They underperformed the market due to some of their holdings. So having a pension stabilization program is important so you can hedge against that. So I'm going to stop there a second and answer any questions you might have about where you're at today, where you might be looking for tomorrow. So I'll answer any questions.
Thank you. I'll start to my right. Director Orozco, do you have any questions at this time?
I don't have any questions at this time. Thank you.
Okay, Director Buss?
Yes, I have a couple questions. So first on this page, which portfolio are we in?
You're in the 60/40.
The 60/40. Okay, thank you. And then, so I was curious, how often do they adjust the discount rates for the three funds? I saw one of them was as old as 2022.
Great question. It can be annual. It can go for 3 to 4 years. That the OPEB and the retirement plan is those discount rates are applied by your actuary, and CalPERS typically adjusts it annually, and we wait to see what those numbers are. But they have been fairly consistent at these figures over the last several years.
Okay, and I'm sorry, did you say that our actuary or do you mean the fund's actuary?
I can jump in. So we have actuaries that do our own GASB reports on these liabilities, and so that's what he's referring to.
Oh, okay.
Mhm.
Thank you. I was just curious on. And then my next question was, so with the volatility that is going on, currently you reallocate quarterly. If the volatility continues throughout, will you reallocate more often than quarterly, or will you continue to reallocate quarterly?
We constantly are looking at markets, which is why we've outperformed benchmarks. As an example, and I'll go back to January of 2024. There were several predictions in the industry from the largest institutions in the world that we meet with on an ongoing basis. In 2024, in January, the largest firms in the world, Fidelity, Vanguard, Apollo, BlackRock, Blackstone, they were projecting that the S&P would do no more than 8% for the year. Most believed with markets that there would not be a Republican sweep. And the Fed had been promising to lower interest rates since November, or hinting at lowering interest rates since November of 2022. So in January of 24, no interest rate had been reduced. So what ended up happening? Interest rates were not lowered until September of 24. You had a Republican sweep, And the S&P went up 26%. Now, the majority of that growth happened in the first 6 months with an incredible growth in AI led by NVIDIA. You probably all read about it. But starting in the third quarter of July, you started to see a peel back on growth. And we did too. We started shifting towards value, more international, undervalued companies. And so we are constantly analyzing the market, studying the best in the world, and pivoting our portfolios. So not only are we reallocating to make sure you're 60/40, we are shifting the strategies that you saw on those previous pages from large cap, mid cap, growth, value, international, et cetera.
Okay. And then, so just curious, in your opinion, is the 60/40 the portfolio that we should still continue to be in?
I think for the OPEB, for the first time in 20 years for any portfolio, it actually pays to have fixed income. You are in a position today with your OPEB and your defined benefit plan, meaning your personal defined benefit plan of the district, not CalPERS, because of your funding and your discipline of funding and the performance, you could de-risk the portfolio to 50/50 or even 40/60. Do we feel that there could be a growth in the market if suddenly there were tariff deals with countries? If suddenly what's going to move the market, a ceasefire in Ukraine, that could definitely have a uptick in the market. Are we seeing that in the near future? We don't. We don't know what's happening with tariffs. Very few do, which is why you see the volatility. But it does pay today, you, meaning a rate of return of de-risking and adding another 10% or 20% to your fixed income, because interest rates in bonds are paying at 4.5 to 7% today.
Do you think even with the, say, the ceasefire or the tariffs, that the uptick in the market would be long holding, that it would make sense, or would it be something that would be a blip and then go back down? Like, do you feel
You
like
know-
that would be a growth that would continue, or it would just be as the headlines hit and then the market would react and go back?
Well, I sure wish I had the crystal ball, and if I did, we'd all be on these islands called the Hawaiian Islands, because we would have purchased them. But we feel that with markets at all-time highs, and by the way, I want to remind everybody on the call, your portfolio is still higher than it was last July and August when markets had hit all-time highs. So you're in a great position today. We obviously had markets hit differently. Markets always get hit. There's always going to be some issue, whether it's economic, political, or 5 years ago, social in the pandemic. I can't predict whether or not the markets are going to do 26. The greatest minds in the world a year ago, January, predicted the markets would do 3 to 8. They did 26. They were wrong. Every major firm in the world. But what I do know is a coupon on a bond is a coupon on a bond.
Yeah.
And today, de-risking helps you more than it hurts. And so if we do see more volatility, you're buying downside protection, but you're getting paid for it. 3 years ago, that bond rate would have been 2% or 2.5%. You would have de-risked for protection, but you weren't getting paid for it.
Right. And so, and just curious, if we did decide to de-risk and move into a less risky portfolio, how difficult is it to move back? Should we choose? I mean, is this like an annual decision, a quarterly decision? How does that work?
No, we are meeting with your team, Jim, Melissa, and the rest of the team on a quarterly basis. We
Oh,
are
okay.
reviewing this constantly, and we are rebalancing constantly and shifting the portfolios to where we see markets are moving. So it's very, very fluid.
Okay, thank you. That's all I have. Thank you very much.
Thank you. Director Heffer?
Yeah, I'm a little, maybe not concerned, but at least curious. Several places you've referred to de-risking the portfolio, which, you know, theoretically makes sense, but with at least, I mean, a lot of this volatility has just been in recent days and weeks. But, you know, it sounded like the so-called experts were caught a little bit off guard when the stock market took a hit and the bond market took a hit. Historically, long term, it's the stocks go down, bonds go up. Wasn't been happening. But the other concern I have about using the term de-risking, that would assume that there's a somewhat rational control of the fixed income markets. But with, and again, this is a political as opposed to an economic situation. But if changes were to happen in the Federal Reserve, if the administration somehow forced lower rates into the system when, at least from what I've been reading recently, most economists think that would be disastrous. Is that truly de-risking by moving to a 50-50 or 40-60 type portfolio?
Good question. So a bond today, when you purchase bonds or bonds being issued, they're being purchased at interest rates in the current marketplace. So let's just use 4.5%, 5% or 6%. As you know, a short-term treasury right now is about 4.2 to 4.3. So when you buy a bond today, you're locking in a coupon on that bond for a period of time. If interest rates were to lower, you're still getting that 4.3 coupon, and the value of your bond actually goes up because a new issue 2 months later, they're going to be issuing at a lower coupon, for instance, 4%. So if interest rates go down, the value of your bond goes up and you continue to earn your coupon at 4.5. Now, if interest rates go up, like they did in 2022, you might recall your bond values went down because you own a bond at 4.5 coupon and hypothetically interest rates went up to 5. That made your bond less valuable at that moment in time. Now, you only lost money if you sold the bond. If you held the bond to maturity, you didn't lose any money. So right now, with what we're seeing, we agree with you. We don't see interest rates lowering, even though the administration, as you just read, probably today and saw yesterday, is pressing the Fed to lower interest rates. They're not lowering interest rates because there is too much uncertainty in the tariff moves right now, which they're fearing could slow the economy down. Is anybody terribly concerned we're going into a recession? No, but they're more concerned than they were 3 months ago. And if we go into a recession, you will more likely see the Fed lower interest rates than you see increase interest rates. So by taking some chips off the table, i.e. your equities at 10%, and buying into a 4.5 hypothetically, and interest rates go down, you're going to get 4.5%. And if you did this in a year, you might only get 4. Does that make sense?
Oh, yeah, it certainly makes sense. I guess I'm far enough removed from, I was mostly in the equities side of the business rather than the fixed income. But are interest rates solely tied to the Federal Reserve rates? Because what I understand, what I've been reading is that interest rates, as much as anything else, reflect confidence in the U.S. economy and the U.S. dollar. And if both domestically and internationally that confidence is no longer there, even if the Federal Reserve was to reduce interest rates, would that automatically and permanently reduce the US government bond rates?
Well, let me break this out because the first question was, how do interest rates vary? So obviously the safest investment in the world, despite recent volatility, is still a US Treasury. So you're talking about the safest investment in the world. And when you look at the next level and you go from AAA to AA to single A to triple B, the higher the yield, it is based initially off of what the Fed is issuing our treasuries. So if today the Fed is at 4, a AA bond or a single A bond to attract you as the consumer to buy it, they need to be at 6 to 7. A single A bond needs to be at 8. Maybe a triple B needs to be at 10. So it's about the security and also the benchmark of which the Fed is issuing the safest investment in the world, and to entice you to buy their 8% coupon bond, they need to be high enough over the Fed's rate to attract you to buy their bonds. So that's where do interest rates lie according to the Fed? Every category of debt, public debt and private debt, feeds off of interest rates. And I'm going to add one more piece. The stock market, the real estate market, it all starts with the Fed. Whatever the Fed is doing dictates every market out there. So though Warren Buffett might say long-term equities will always outperform bonds, and he's right, interest rates still drive what consumers do and investors do. And so the rationale of analytically looking at where you're at today with your 60-40 and what long-term projections are, you're not playing catch up. Like you said, you're overfunded on your OPEB. So you could look at this two different ways. I don't need to take this risk anymore. Let's take some of the chips off the table and lock in something for the next 5 to 10 years on half of the portfolio and earn 5 to 7% with very little risk. Or you could argue, what do I have to lose? I can even be more overfunded and stay in more aggressive stocks, but we're doing this during an extremely volatile time. I think you need to stay there for your pension stabilization because your hurdle rate is 6.8. I could be very comfortable with taking the portfolio from 60-40 to 50-50 on your OPEB and your pension based upon the projected discount rate of 5.39.
Okay, thank you for that.
Mark, I have a question. First, I feel like I've been at one of those Saturday workshops where you're trying to hear all that you can from a professional and you leave with your head hurting. So I'm working through that, but thank you. The concept of de-risking, I just keep thinking that if you are lowering your risk, you're lowering your rate of return, or if you're increasing your risk, you're increasing your rate of return. But I'm trying to get the concept of de-risking. Am I
It's a
mixing
term
these
that
up?
Go ahead. I'm sorry. Go ahead and finish.
I said, am I mixing these up, or is it one and the same?
It's one and the same. You are lowering, by taking any portfolio. I'm going to go to that chart you see here, the red and the green. Obviously, you can see here, the more equities you have, the higher the rate of return potential, and historically has provided. The lower the equities, the lower the downside risk. Okay? So right now, as an example, over the last month, we've seen bonds drop 1 to 4%, but we've seen equities drop from 5 to 20%. Today, you're very healthy with the money that you've put aside in the past and have grown during this very, very challenging time to predict what is happening. Fixed income, it at least pays you to be conservative. 3 years ago, I would told you if you de-risked or reduced your equities, what you're doing is buying yourself an insurance policy that if the market dropped 10 to 20%, you're not going to drop as much. Today, by doing it, you at least get paid to do it versus break even.
A hard concept to grasp, but I hear what you're saying.
And inflation is the critical number. If we earn 3% in bonds and inflation's 3%, we're not making any money. Your previous speaker, one of you asked a question about, are we better off outsourcing some of these services? And I think when he was explaining some of the costs, he said, and oh, by the way, they raised their costs because of inflation. So when you earn 3% and inflation's 3%, you're not making any money. If you earn 6%, you're making net 3%. So we have to take that into consideration when analyzing portfolios.
Absolutely. Well, along with many other things, but absolutely.
Exactly.
Okay, so in your, I'll call it a proposal, suggestion, however you're looking at it, where we're currently at 60-40. And that if we wanted to de-risk, we could go to 50-50 or 40-60. And you're indicating that even by de-risking, we're getting paid to do it, so to speak. But if you're, I guess, very cautious, then I guess you would go all the way to 40-60. If you're kind of maybe in between, you would go 50-50, but 50-50, you're kind of, it's like you're moderate. You're not really, going all in or pulling all out. You're kind of just somewhere in the middle. So is that like the safe haven type of place to be, where you just say 50-50? Well, that way you kind of, whether it goes up or goes down, at least we're kind of staying in a good position? Or is it the type of thing where you say, no, if you're going to do it, you want to do either 40-60 or 60-40, either stay where you're at or really de-risk all the way?
No, I'm very comfortable at a 50-50 for 2 of your portfolios, because you are overfunded, you have socked the money, and you've performed well. You've done everything you set out to do years ago. So 50-50, which is considered to be a balanced portfolio. And then it's as important to know the equities we own, we position those equities, large cap, mid cap, small cap, growth value, etc., tech, not tech. We're building that on your behalf to perform the way we performed. I am very comfortable with you at 50-50. I don't believe you need to go to 40-60. If the 5 of you today came into this meeting incredibly scared of the market, of what was going on, and didn't have an understanding of markets, I would have told the committee that if you're that scared, then a higher insurance policy is de-risking even further. And as you can imagine, in the last month, we've had those conversations with different people.
Oh, absolutely.
But you are funded well. You can afford to have more equities in your portfolio. And we're really only talking about a 10% swing. But again, the numbers that are critical is these are the long-term projected numbers you see at 50-50. and they are meeting what your obligation is at 539. And as one of your previous directors asked, well, in 3 months, if things change, could we change it? And the answer is yes.
Okay. And I just want to clarify one thing. And so your recommendation was to keep pension stabilization at 60/40, but for OPEB and defined benefit plans, de-risk 50/50 or to 40/60. Is that correct?
Yeah, for the committee to consider, or the board to consider looking at 50/50 or 40/60, but we are very comfortable at 50/50.
Okay. All right. Thank you. All right, Director Buss?
I have a question. When you change the portfolio to de-risk it and you're buying these bonds, how long are these bonds good for? What's the time frame for them?
Well, great question. First of all, we are buying into very low cost ETF and mutual fund portfolios where these are baskets holding a series of bonds that have different maturity dates. So we're not buying 1 or 2 or 10 bonds. These are hundreds of bonds, and they have a blended maturity date that could range from anywhere from 4 years to 10 years. Right now, more and more bond managers are going longer because they don't see interest rates dramatically going up, and they want to lock in that 4.5%, 5%, 5.5%, 6% coupon over a longer period of time versus a shorter. And if you remember that previous chart when I showed you the treasury projection of the Barclays aggregate over 30 years, you saw that there wasn't much fluctuation in that 4% rate of return. That tells you the industry is thinking that interest rates are either going to maintain where they're at or drop in the event the Fed feels that inflation is intact and we don't see a recession coming. So they are going longer on the maturity. They're going out to 8, 10, 12 years.
Okay.
But it is a blended basket full of bonds.
Right. So it's not, so even if we changed back from deciding not to de-risk within, let's just say, fourth quarter of this year, for some reason, we don't have bonds that we're holding on to that are then at this 4 to 7% interest rate. We are moving the money out of those ETFs, and so it doesn't matter. Then it's going back.
Correct.
So we don't own them. Okay.
Yeah, the fund, and we're using the elite bond managers in the world like PIMCO that are the best in the world at trading and maximizing return for their clients.
Perfect. Thank you.
Any further questions? Okay, everybody ready for the test?
Yep.
Okay. Mark, just one more question. I see on this slide that you have right now, it's referring to the BlackRock capital market assumptions. Is that the standard upon which you and all others measure, or is this just an example?
It is probably, this is called the Aladdin system by BlackRock, and it is probably the most utilized system in the industry by not just us, but CalPERS studies this. They look at long-term projections without bias. This isn't promoting any type of BlackRock equity or bond fund. It is simply looking at these long-term projections in this Aladdin system that they created years ago is arguably, if not the best, one of the best in the industry that professionals analyze and look at on an ongoing basis when they're looking at long-term projections.
Okay, thank you.
And our world that we live in, we're studying reports from BlackRock, JP Morgan, Morgan Stanley, the leading, Fidelity, Vanguard, the leading minds in the industry. And we're studying those without bias to analyze where they see markets going and thus helping us build portfolios on your behalf.
Very good. Okay. Thank you. Any final question? Yes, Director Huffer?
This is probably more of a question for Melissa, but I know we're somewhat at the mercy of CalPERS, and we're always at least a year behind on their projections. Is it wise to get too conservative on the pension and stabilization when we don't really know what CalPERS is going to do?
So you're talking about switching to a 50-50 or something like that? So my understanding, and Mark, correct me if I'm wrong, is that that's not his recommendation for the pension stabilization.
Correct. Correct.
It would stay where we were at 60-40 for that.
Okay, thank you.
That is correct, Melissa.
Okay, thank you. Now notice in our packet here, it says there's background, but there's no staff recommendation. There's no, it's not like for information only. So what is the request, if any? Is this just information only, or are you looking for consensus or input? If you could direct me here a little bit, please.
Yeah, so we actually talked this very thing, you know, we like to be in the habit of actually making a staff recommendation. And this is one of those areas where like you each as individuals have your own, I'm sure, some retirement savings or portfolio, and you've made your own calculations and decisions about how risky you want your investments to be to get to whatever it is you want to kind of achieve for your financial goals. And this is, you know, see, we're all bringing that our own, you know, sense of risk versus security and understanding of the markets to the table. And I think we understood Mark was, you know, going to look at tweaking, so nothing really big and changing. And I mean, we actually came into the meeting thinking we'd just stay everything at 60-40. It's kind of where we're at. But like listening to Mark speak and where we're at and where things are, if everybody's comfortable dropping, you know, 2 of the 3 down to 50-50 just for a little added, you know, security / de-risking. We literally don't have a recommendation or plan other than that, you know, we want the ultimate goal to use this money as a tool to achieve our ultimate goal, which is, you know, have these liabilities kind of taken care of.
And I do just want to add there that we can make, we don't need your board action in order to do it. When we have those quarterly meetings with Mark, if he goes, oh my gosh, you have to do this, we are able to do that. So that's why we didn't want to put a formal action on it, but we wanted to have the conversation with you.
Okay, so it's just a matter of just the general consensus or general input, I guess, feedback. Okay, so with that, let me just open it up for the board. If you had any feelings of it, because right now, you know, what Mark has suggested, I think I reiterated it once, but we'll do one more time, is to maintain the pension stabilization at the 60-40 rate, but to consider for the OPEB and the benefit plan to 50-50 or 40-60. So that was kind of the recommendation. Is that correct, Mark?
Yeah, and let me reiterate both what Jim and Melissa said. Today was, the timing was to have this meeting regardless, to educate everybody about how the overall programs have been doing, the health of the programs. But then lo and behold, we're in this, one of the more volatile times we've seen. In fact, in the bond world just a week ago, one of 2 most volatile times in the last 25 years due to certain items. And so today was more informative, educational, and then providing why, looking at where your account is, what the long-term projection that you want to hit at 5.3, on why, if you were to make a change, either up or down, why you would do it. And so again, we as a firm, looking at your discount rate of 5.39 and looking at where you're at today, we would be very comfortable if the committee and the group said, yeah, I'd like to make sure that we maintain our accounts the way they are, knowing that in the next couple of years, it could be very volatile. And, you know, this is a question we're asked of government agencies all the time. Well, what is everybody else doing? And I can share with you that more firms are staying put or de-risking than are getting aggressive in the marketplace today due to the uncertainty and where markets are at.
Yeah, that's, yeah, goes back to your level of comfort with risk. Absolutely. Okay, so with that, open it up either, is there someone that would like to voice their opinion on whether they would like to make changes or I guess to recommend changes, and if so, what, or to stay where we're at? So Director Huffer?
Yeah, this is at least partly a comfort zone. Um, I look around the board and we've got a couple of us who are, we still have some years of retirement left, but, fewer retirement years than working years probably, but who knows? So, if I was looking at my own personal situation, I might be thinking about, maybe de-risking a little bit. Actually, personally, I'm right now at 50-50. But for the funds that we're talking about for the district, we're talking 20, 30, 40 years. I mean, these are all long-term figures, and I would be somewhat uncomfortable I certainly wouldn't go any lower than 50-50. I feel more comfortable on a long-term basis with continuing the 60-40, but I wouldn't be totally averse to looking at the 50-50 in those two portfolios that Mark's suggesting. So that's, my personal take.
Okay. Thank you for
Um,
Director Buss.
I would say for myself that being in a profession of syndications at the moment and dealing with a lot of
You're comfortable with the risk.
projections of what will be happening over the next 5 years or what have you, and also, being old enough to remember my very, very small portfolio going down to nothing in '08, right? So I think that for me, like I always look, even though I have plenty of years left to work, I always look at wanting to retain principal. And that's always important to me, is that you want to look at like what is the risk for like saving all of this money and having this is huge. And that is not always easy to, you want to try and maintain that principle as long as possible, So I look at it like right now with everything that is going on, and my own projections for my own syndications, that I'm taking a very conservative approach for sure. And I think moving to a 50-50 when you can move back just as quickly, and a 10% change isn't really that detrimental, but also, if it saves you 10%, that's 10%. And we're talking big numbers. We're not talking, you don't just save this in 1 year. So I think that for me, I would look at it right now until you see the volatility in the tariffs situation and what will happen with the Fed, if he's keeping his job or not. I think that my perspective would be moving to 50-50 is not a bad idea, because you can move back in a quarter.
Mhm.
So to take that approach now and then see how, this weathers out over the next 9 months, I would be more comfortable with that than staying. And you still have a majority of it in a 60-40.
Mhm.
So you're really just only moving a smaller amount of the money to de-risking it.
Mhm.
That's my opinion.
Thank you. And Director Orozco.
Thank you. I feel like I just got through a crash course similar to. But that being said, I think I have to agree with my fellow board members and their recommendation of going to 50-50, simply just based off of your guys' various concerns and all the information provided. So
Thank you. And just my personal perspective, again, thinking back to 2008 and seeing retirement funds taking a dip, but then looking at the course of how long they've been in there and saying over time, it's been pretty much a pretty steady rate of return. Ups and downs over the years, but over the long term, it's a pretty steady rate. So I try to take more of a longer term look and not be too reactionary. Especially, I don't want to get into day trading and, have heart attacks every day. But I do like the idea where at 50-50, we're still meeting our goals. And that's kind of what struck to me is like, if you stay 60-40, you're doing better than your goals, but at 50-50, you're meeting your goals and perhaps even exceeding them a little bit. So with a little de-risking, we're still meeting our objectives. And so that kind of resonated with me a little bit. So I would feel comfortable with that 50-50 in those two areas where you're still, as you mentioned, retaining your principal, still able to respond as accordingly. And then, as we heard, if things need to be adjusted over time, they can be. But I think that would be something that I would recommend as well. So is that enough input or feedback? I don't think you said you didn't really need a motion, just kind of some feedback. Do you have what you need?
Absolutely. I think with this information, I think what we'll do is we'll be sitting down and talking to Mark, and we would tell him, let's try to move the retiree enhancement and OPEB, the two lower amount funds down to 50-50 and keep the PERS liability one at 60-40 and give them the green light to go move in that direction. And, this is one of those things where we don't really have a set schedule. It's not necessarily annually or, I know Mark was probably here at least a couple years ago, but, we'll bring Mark back as much as, we feel like the board wants that. I do, since I do have the mic, I do want to say how much we appreciate Mark and his insight and wisdom and energy. We do have these quarterly meetings. He's got an excellent staff. There's others in his organization with not quite as much energy as Mark, but have a ton of energy. And I think when we first met him years ago, and we kind of thought about moving away from like the herd, the safety of everyone just does PARs, or that's kind of what you do. You're in government, just do what the other guys did. No, we really, Melissa, we really scoured what other investment houses were doing, and we listened to what Mark had to say, and we talked to some other, colleagues that have kind of gone with the Schuster Group, and it's just been, I can't tell you how much more information and time they spend with us trying to, figure all this out. So the fact that he's willing to do this for an hour with the board and kind of get us all up to speed is just it's a really neat thing to have. So I appreciate the board being interested in taking the time and listening and understanding. And then Mark, of course, for being the professor and guider on some of this stuff. So.
Okay, thank you.
Yeah.
And Mark, do you have anything further you wanted to add or ask from us?
Well, first of all, Jim and Melissa, thank you very much, the board. And I want to just share, most importantly, we have a very large team, and they're the ones that provide Jim, Melissa, and the entire organization this white glove service. So I'll give them all of the credit. But again, tonight was really about information. I've been texted and emailed and called hundreds of times over the last 3 weeks because it has been one of the more volatile times and different than we've ever seen. I've been on the phone with senators that are part in the middle of this, and they all don't know what's going on. And these are both sides, Republicans and Democrats. And so we thought tonight would be very informative just to talk about it and what's going on. And you've all made accurate statements, which is we don't have to move. You're right. The first gentleman, I apologize, long-term over 30 years, yes, equities will outperform bonds. They will. And, short-term, it could be the opposite. Long-term, and you have a long-term obligation, equities will outperform bonds. But the purpose of what we've done and why it's been successful is we've been agile and we've moved with the markets as they've moved. So we did just wanted to inform the board tonight, because we've had a lot of boards concerned with what's going on and how it affects their assets that, again, previous to our time on the stand, you had your group talking about everything you do for your community and the cost to do that. So this money is important, short-term and long-term.
Thank you.
Cool.
I just was thinking of us a quip that Winston Churchill said or something like it, but we are not living in an uninteresting time.
You are correct. So thank you all for your time. We will convene with Jim and Melissa, and then I'm sure we'll communicate whatever decisions we end up making. But thank you all very much.
Thank you, Mark, for your presentation and for your team as well. Thank you.
Thank you.
Mark.
Yeah.
Bye-bye.
Okay, we'll check that one off the list and we'll move on to item 8B. If you, Madam Clerk, if you could read that into the record for us, please.
Legislative updates on several bills introduced in the California legislature, including but not limited to SB 499 Stern and SB 315 Grayson.
Thank you. And I'm going to turn this over to our general manager.
Yes, thanks, Chair Nichols, members of the board. And I think setting the stage for kind of this odd meeting we have with not really clear, decisive recommendations on some action items. That's actually just the circumstance that we found ourselves in. We knew that we didn't have some action items. Sometimes we would call you guys and say, we really don't need to have a meeting. We don't really have action items. Let's cancel it. But few reasons we wanted to go forward, because we expected to be doing a closed session. That didn't happen. So good news is there's no closed session tonight. Don't worry about that. But we did want to get Mark in front of you again and just kind of revisit the money that we've, saved and how it's being taken care of, and, some sense that we're paying attention. And kind of we also had the public hearing on the budget, and we published that in the paper saying we'd have these, open opportunities for people to come and chat about anything. But I have some legislative things that are also related very closely to money. So that's kind of the theme, I think, as we're into budget season. That's about some of our savings and how to handle our long-term liabilities. This actually, what I'm going to be talking about is the potential for the rules that we've been playing by pretty much since Prop 13, and some risk, very significant risk the district has given some of this proposed legislation. So the main focus of my talk will be on what's going on with some proposed legislation. Senate Bill 315 by Grayson is the one I'll spend the vast majority of the time on, but there are some other bills. Chair Nichols is on the CARPD Ledge Committee, and hopefully chime in as we go through any of this. Melissa Smith is on the CSDA's Ledge Committee as well. So we have some, we're paying attention to this stuff that's happening at the Capitol as well. I'm bringing up SB 315 because you see our CARPD has kind of asked us to really sound the alarm on this one. There have been, over the past couple of years, the state setting the stage. The state has really been trying to do whatever it can do to, frankly, force, encourage, cajole, require cities to allow for more housing to be built. And they've been passing bill after bill for the past couple sessions. They've finally got to the point where they're now looking at impact fees, and not just the impact fees, but even QIMBY, which is, to be technical, not technically an impact fee. It pre-existed the Fee Mitigation Act and all that kind of stuff. So this was around before Prop 13. QIMBY was. And QIMBY, what is QIMBY? So QIMBY is something that is named after a legislator. It was created as the post-World War II housing boom occurred, and these giant tracts of housing were getting slapped up all over the country at a pace that somebody finally said, wait a second, yeah, you're getting all this housing, but where are the parks? And so somebody trying to finally figure out, wait a second, what you need to do is, if you're going to build a certain amount of houses, they're going to have a certain amount of people, there should be a certain amount of parkland that automatically comes with that. So the idea of the QIMBY Act is, when you have a subdivision of 50 or more units, we, under the city's municipal code, because our authority actually flows through the city of Thousand Oaks. So they're the land use authority. They're the ones that have the ordinance on their books. And it says if you're going to have 50 or more unit subdivision, we have a right to ask for a dedication of land to serve those future residents. So that made a ton of sense and worked perfect, as Thousand Oaks was this area with giant big tracts of land where you could master plan these big communities, design these big tracts of homes, you know, multiple hundreds of units, like in the case of Dos Vientos Ranch, 2,300 units master planned, providing over 70 acres of developed parkland, 1,000 acres of open space because they had the land. But we've evolved, Thousand Oaks in particular, into a situation where there aren't big tracts of land anymore. And we are still getting 50 plus unit proposals, and they're just on much smaller lots. So it's making the ability to get the park dedication out of that harder and harder and harder. And I think the goal of Senator Grayson is to try to make it less expensive to build housing. I will say the concept of his bill is, okay, well, there's already all these parks out there. If you're building infill, you should never have to provide more than 25% of your land area. So if you had a 10 acre lot, you should never have to provide more than 2.5 acres of that 10 acre lot. And so you can build 300 units on 10 acres, but you know, you can't ask for 3 acres. You can only ask for 2.5. Try to work it out. That's one part of it. But the more damaging part, frankly, for CRPD is we've done a really great job over the years of thoughtfully putting the parks in places where people live and dispersing them in a system so that most people live within about a half-mile walk of a park. Well, this bill says that if there is any park, as the crow flies, within a half mile of a future development project, it doesn't have to pay Quimby at all. So basically, I'm getting a little far afield of the thing, but basically, this is just a little, it's in your packet. It's a little bit of a explanation from CARPD about the importance of the Quimby Act. And I kind of went through that history. But it does say that in lieu of the land dedication, the park district can ask for a fee instead. And that makes sense because sometimes you have to amass the fees from several different projects to then, you know, get enough millions of dollars to buy the land and build the park improvements to serve them. So it's dedicate land, but if you're not going to do land, pay a fee. So keep going. So as we're talking about SB 315, that's the first proposed one. So that's the piece of legislation I'm talking there. So we're opposing that, and the letters for us opposing it are in the packet in CARPD. And I'm really glad to say that both Costco and the city have also submitted letters at this point. And I think we heard on the call today, the ledge call, something like 35 other agencies or something like that are up there. But I do want to point out some of the material that's being promoted by YIMBY. And we've stayed off all the housing. Like when I say we, the Conejo Rec Park District has not weighed in on City of Thousand Oaks housing proposals other than to say, hey, we have a fee associated with your project. And it's a, you know, if we know what the units are, we can kind of give them a sense of what that is. But there's definitely a group called YIMBY that has been supportive of housing, and we haven't appeared to say we oppose any housing. We're just saying, hey, if you're building it, you just should build the parks or provide the fees along with it. Well, YIMBY is the sponsor of the bill, and this on page 48 of your packet, they have a flyer. So keep in mind, remember, you can't ask for more than 25% of a developer's land, and you don't get any fees. You're totally frozen out of fees if there's development within a half mile of an existing park. And what just fries me about this, and I think this was created by the YIMBY folks, I don't think it came out of the author's office, but in the box in the middle of the flyer, it says, parks are a beloved part of our neighborhoods and quality of life, but they are of greater value when people can actually live near them. So for them to try to use their legislation to suggest somehow parks are less likely to happen if they pay a fee or provide the land for us to put a park next to the building is just, it just fries me. It just feels like they're turning the truth completely upside down and inside out. I understand what they're saying is that fees are getting so high that nobody's even gonna try to build housing. I'm sorry, parks, yes. The fees are getting so high. Well, no one's gonna try to build housing, which means you're not gonna get parks. Like, sort of like nothing's gonna happen if your fees are so high. But what we understand talking to the author's office, the senator's office, the examples that they pulled out were all from Silicon Valley cities, which have underlying land values of like 10, $12 million an acre. And so their Quimby fees calculate out to literally like $70,000, $80,000. There's even one, I think, that they were saying was $100,000 a unit, like per unit. So they're kind of quoting these eye-popping numbers, but as you know, our multifamily fee is $12,000. And as I heard on the call, a lot of other agencies were kind of in this similar boat. It seems like a lot of money, but not when you add up the cost of us actually having to buy the land and do the improvements in a location that serves those future residents. So it's something that everybody who currently lives here in Thousand Oaks has already paid for. If you live in a house here in Thousand Oaks, you've already paid your Quimby fee. You did your share. You helped by having your developer donate the land for the park, or you provided the fee. And it doesn't quite feel fair to have all of a sudden a whole new class of folks not have to pay what I consider a fair share to get into the community. So that's 315, and we're opposing that. 677 is another bill that, if you recall, 5 years ago now, we had a bill that said that we couldn't collect fees on ADUs that were below 750.
49.
749 feet or less, but less than 750, we cannot collect an impact fee on. So SB 677 kind of ratchets it up to 1750. So that creates, I don't know how many units that would wipe out, but that would be, I'm guessing, a whole lot more units where the fee's waived. You can't collect any fee. And then there's another, and of course we're going to oppose that. And then there's another one that is a little more, I think, reasonable and sane, which is basically very specifically targeting affordable housing. So if you're building a certain kind of income and affordability housing product, then there might be some waiving of the fees for those units, which seems a little more in sync with the notion of trying to build more affordable. So those are some of the bills. They're all basically going after what CRPD needs to do our capital projects. Like, that is what we have used to do a lot of the capital projects. I do want to point out at the top that current SB 13. So there's a slide a little bit later that we're going to show you about what the impact of that law for 5 years has been to us. So keep going. That's just the letter that we're mentioning we oppose. So CARPD and CRPD have both opposed. Here's what we've collected in 20 years. So you see at the first table on the left, the lower right below that, it says date range, January 2004 to April 2025. So 20 years of collecting Quimby fees. We've gotten $13 million. And you see 0 in zone 6. Well, that's because that's Dos Fianos master plan community did, more parks per population than anywhere else in the community. It's an awesome, they have their parks per population down solid. So the fees that we've gotten so far over the last 20 years are 13 mil. Here's what's important though, and whether this new legislation affects already entitled projects or not is a legal question that I don't know what the outcome would be per se. I could make arguments both ways, but if, say, this legislation passes, the question is, there's 3 entitled projects that are actually going to owe us about $11 million in fees. It's the Kmart project. There's a project by Amgen and the 500 Teal Boulevard. So that does a lot of capital for CRPD. Like that is what helps us finish off like a Rolling Oaks neighborhood park or a Lynn Oaks park, or it helps us buy new land to do a new park or build pickleball courts or turn Conejo Creek West into a facility that everyone can use. So that's all it. So what's at stake? That's kind of what's at stake. Those are all entitled. They haven't pulled their building permit, so we haven't gotten the fee, but that's what we're talking about. And then the map on the right is kind of just showing you the zones. Remember how we divide ourselves up into 6 zones? That just shows you the zones where the units that are getting built. And it's, kind of, well, a lot of it is along the freeway right now. So that's kind of what's happening along the 101. And next slide. So that law, I said, that's been in effect for about 5 years, that SB 13. It was enacted 2019, but I think went into effect January of 2020. So that is how much we have not collected in ADUs that are below 750 square feet. So we've actually done the calculations as we are those kind of pass our desk. So 309 below 750 would have paid 920,000, which depends how you look at it. That could be one single really awesome playground redo at a community park. Like when we did Conejo Creek North, it was $1.1 million. Dos Vientos Ranch playground was $1 million. So in some ways you could say, well, what's so all those homeowners, they didn't have to pay, but $1 million kind of matters. So that's already happening to us. You can go on to the next slide. So this, if you look at the top, chronology of park and facility acquisition and development, this slide is nothing more than an opportunity to point out, should do the next little thing. Yeah, opportunity to point out that the most recent actual dedications are down there at the bottom. And that is Dos Vientos, Sycamore, and Del Prado. Not surprisingly, all inside Dos Vientos Ranch, but in 2002, 2006, and 2007 is when we had those lands dedicated to us. So ever since then, we haven't had a single land dedication. It's all been by fee. And that's because, nobody has come forward with a big enough piece of property to say, here is a park and I'm not going to pay the fee. I'm going to give you the land. Or I guess 500 Teal Boulevard's a little hybrid of the two, right? We have that. We aren't going to actually own it. We'll have a deed restriction on it, but we'll have a little bit of green space there and a little bit of fee. We kind of did a hybrid with them. But I think the time of getting big land dedications is it's, hasn't happened in what is that, 18 years? It was the most recent, was Del Prado Playfield. All right, next slide. Okay, so this I think is that's all the little dots of different colors are our parks, our developed parks in our community. Those are the half-mile radiuses. So anything in, what is that color? Pink, purple? Purple? Anything in purple wouldn't have to pay a fee. If you were to try to develop anything within the purple under this proposed SB 13, you wouldn't have to pay us a fee because we've done a really good job of spreading parks around the community. So that's why we've really kind of pulled the fire alarm on this SB 315, and we're kind of more engaged than we ever have been at this early stage in a piece of legislation. So these next circles are kind of pointing out where some of the, I would say, needs are based on the city's general plan and where we currently have a park deficiency. So you can see it's right along primarily the 101 corridor. The ellipse at the top is actually that Jantz Road Park that we just saw. That would actually help fill in that blank space a bit. That property on the way into Lindmere. But really along the 101 freeway is where we definitely we already have a lack of parks. Why is that? Because up until the general plan change, that was all commercial, office, industrial, right? Mm-hmm. Now that is also residential, and not surprisingly, we don't have a park there, and we need to figure out a way to serve those areas. So we need to collect those fees because that's the most expensive real estate in town, right? You're $3-4 million an acre there. So that's what that's what that looks like. And with that, I spent a lot of time on 315 and some of the other fee bills. I did in the memo mention the Stern bill, 499, and I want to do that because CARPD is a sponsor of that. Is that right? We're the
Yes,
sponsor.
yes.
And what's cool about that bill is Senator Stern, I believe, was the only senator to vote against a bill that delayed the collection of park impact fees and Quimby fees from building permit to C of O. So that can create a delay of a year to 3 years on a really big, long project from when we are, supposed to collect it to when we actually collect it. That's just a time value of money thing, but what we're trying to do is get the money when we need to start. We need a lead time too, to get ready to invest that money to support those future residents. And now we're not going to get it until they move in, essentially. Senator Stern voted against that, and I think was the only senator to vote against it. And he's actually introduced language to try to fix that a little bit and create a carve out. There's already a carve out for police, fire, emergency services. So if you're collecting a fee to do police, fire, emergency services, you get your fee at building permit. Senator Stern added to police, fire, public safety, parks that are essential to emergency services or operations or supportive of that, which are identified in like a community's hazard mitigation plan or something like that. So it's a narrow carve out, but it does acknowledge that some of our centers are used for American Red Cross shelters, and some of our parks are evacuation centers or staging areas for emergency operations. So it kind of has a nod to the importance parks play in an emergency community situation where you need open space or a communal big building to do your operations in. So we appreciate Senator Stern for introducing that, and we're sponsors to that. I also did a handout of what CARPD's Ledge Committee took a look at today. And there's a variety of bills in here. I'm not going to go through them at all, but just to give you a sense of what, I think these meetings happen, monthly at this point, or?
Is it that or every other month? I forget now.
Yeah, so you're a little busier in the spring, and I think you slow down in the fall.
Depends on the season, yeah.
Yeah, so this is some of the bills that CARPD are looking at and their positions on them. But this is one of those years where there has not been legislation introduced that hurts the park district financially as much as this kind of slew of no Quimby bills. I can go back to, there was a time when there were bills to dissolve special districts. That was a little scary. There was a time when it was sweep reserves out of special districts because they saw these big, I'll use a water agency rather than that. They're saving up to do a giant water treatment plant, and they have $50 million in the bank, but they need 70 million to do the project or to let the contract. And the state at the time said, wow, these special districts just have all this money sitting around. We should sweep it, because this was back in the early 2000s when the state was having the budget crisis after budget crisis, and they were literally going to pass legislation to sweep money out of special districts. So, and then you have to go all the way back to ERAF when the state literally took property tax from special districts and just said, instead of getting 6.13%, you're going to now get 6%. We're going to take that 0.13, shave it off. All sorts of special districts lost a healthy chunk of their property tax revenue to ERAF until the voters passed the constitutional amendment that put a stop to that. And now the state cannot just reallocate special district property taxes like it once could. So that is a great protection that we have. But there's not many sources of money. We have our property tax, and then we have our fees, and they're going after the fees. So that's where we're at. That's the legislative environment we're facing. And again, I think housing, homelessness, vexing problem. Building a lot of units without any regard for where they're going to recreate or parks or open space, to me, is really bad policy. that no one will notice in the first 5 years that, people are getting in permits and waiting to build the structures, and then they build them, and then 5 or 10 years from now, people are going to go, what the heck happened here? Where? And I just don't want to, I don't want to see that future. I really think it's a mistake for the legislature to go after parks. So we're opposing that. So I'm available for questions.
Yes, Director Buss.
I don't really have any questions, but I do want to make a couple of comments that I think, as someone who is a real estate syndicator and does build ADUs and what have you, and looks at these fees and has to play them into all of my projections, I really think that it's sad that someone is trying to take the most expensive area and play it against all of California. And I really don't like those kinds of things when I see them, because it's so far from the truth. And when you talk about California's housing shortage and the affordability crisis, well, smaller units are what are more affordable, and you already can build. I mean, we have built ourselves over 20 ADUs just in the last year, and they're all under 749 square feet, because that is who the low income population, they need that. And one thing, when I do go to buy apartment buildings and add these ADUs, I am looking at where is the green space for these people, because a lot of older apartment buildings, you're buying them and they're like that 2-story garden style that had the kidney bean shaped pool in the middle. And, most of those have been filled in because they didn't want them. So it's like, you want them to be able to, people want to have their pets, like you want them to have places to go and walk them. So I think that it's really sad that people are not, just because you don't live in an apartment doesn't mean you can't put yourself in their shoes and think about what they would want. And this is one thing that really upsets me as an apartment owner. And I remodel my units to with the same look I remodel houses in Thousand Oaks. And it's like, people assume just because you're living in something smaller that you don't care about these other luxuries. And it's like, you don't have a backyard. You don't even have a balcony sometimes. You don't even have like a little anything to sit outside. You walk up and you walk in your door. And so that's just the stuff that, like, I think people just are so far removed from the people that they're impacting, that it's sad that they come up with things just to, who knows who's even wanting him to do this and make it so far from the truth, for the people that actually need it. So, and I do think that we need more smaller units, and they are more expensive to build. So I really appreciate that you are all supporting this and going after this. And as someone who is developing housing, I really think that it is important for us to contribute to the community in which we are building in, so that the reason people love to live here, and having had served, I don't know how many people who have relocated here in residential, people move here because of the open space in the parks, in addition to the amazing schools and the proximity. So it's like, I really just feel that people just don't think about what they're impacting. And I am very happy that you stood up for this. I think that as a developer, these fees you put into your numbers. If you want to impact people being able to build more, then provide government programs for more affordable loans for building, because that is where you will get more people building. It's the cost of money that is affecting people right now on building, versus the little fees that they already had put in, and the fact that the interest rates moved the strongest that they've ever moved, or the fastest they've ever moved in history, in 18 months. That's why people aren't building. And so these things are just so nearsighted, in my opinion. So I appreciate you writing this and taking the time. Thank you to both of you for being out there and advocating for us, because I do think that these are absolutely a little ridiculous. Thanks. That's my comment.
Yes, Director Roscoe.
Thank you, Chair. I just had a quick question about whether or not we've had sit-down conversations with Senator Stern and even Assemblymember Irwin about these different pieces of legislation.
not with them. I kind of take cues from our lobbyist up there, and he's right now saying with all the bills that are up there and everything, and this is just still in the local government committee. So neither Senator Stern or Irwin are involved in that. So he's kind of like, just focus on the local government committee. And so that's kind of who we've spent all our energy on. And should it get out of that committee, we'll absolutely be asking them to, start to be more involved.
Great, thank you.
Yes, it's one thing I've learned is there's definitely a process to follow through this that I'm completely oblivious to, but learning rapidly. And just kind of following cues and direction. But yeah, just like you said, it kind of depends on the committee. Is it in the assembly? Is it in the Senate? Who's on that committee? Who do they need to target? Okay, who has a park district in that area? Then you go talk to your person, you go talk to your person, and you build a coalition. It's definitely a process. And I'm glad there's somebody controlling it, or at least hurting it. I don't know if they're controlling it. But the other thing I wanted to mention was that in the conversation today, our legislative advocate was commenting about why these bills are moving forward. And it's typically because there's a lot of money and a lot of organizations that are pushing this forward, not necessarily that it's coming from the public, that there are other entities. So it's part of the political process. Director Hupper, did you have any comments?
Reacting to the comment that Jim made, said, well, in 5 years, they're gonna wonder where all their park space is, but I'm not convinced it's even gonna be that long. I mean, someone moves into a nice new place in a 5-story building and they've got little kids in school, and Susie comes home and says, why does Mary have a nice park right next to where she lives and she can walk to the playground, and we've got to hop in the car and drive for 5 miles to find a playground? So I suspect people are looking for housing. Probably parks and open space maybe aren't first in their mind. They want a place that's nice and that their family can live in. But it's not going to be too long before they realize that they don't have everything that those of us who have a home and have had a home for 20, 30, 40 years, that we have all these nice amenities that they don't have. So I just, it's not fair that what we have, these new residents won't be able to have. So I'm really glad that, the CRPD and CSDA and other organizations. I was really pleased when I chatted briefly with Mayor Newman at the park this afternoon. They said that he just signed a letter that the city sent on this issue. So I think that's terrific, because I mean, the city's been pushing for housing, but they realize that it's more than just housing. So I think that's terrific.
That's maintaining a livable community is what it's all about. Anything else from the general manager? We got good. Okay, any other questions? Otherwise, that was just a informational presentation. So thank you for the update. I think you covered it well. Thank you for doing that. Okay, we're moving on to item 9, new items. There are none. Item 10, reports and announcements. We have a few items in our packet. Were there any questions or comments of staff regarding any of those? Okay, seeing none, we'll move on to department reports. Parks Division report, please.
Thank you, Chair Nichols, members of the board. As I shared earlier, we've had some attrition happening in parks and planning. So, excuse me. So Patrick's been with us as park superintendent for the past 4 weeks. We have a new planner, Tabitha McAtee, joined on Monday. So she finished 4 days of work this week. And she comes from the city of Thousand Oaks, from the planning department there. So a good liaison for the work with development happening, but also permit submittal and processing. And I know I mentioned Luis joined us a 2.5 months now or so. And so you can start seeing Luis's name pop up in the packet with the Quimby dedication fee letters as part of the reports. And then as Patrick's spot opened up in the field, Mike Burns actually sliding over as a ground supervisor to take over Patrick's spot. And then we recently, just this past day, hired Jesse Hare. He has no relation to Tom Hare, but he's from Newbury Park. He's worked for the district for about 10 years now. And so he was our grounds worker 3 for a bit at Sapwe. This past year, he's been a crew leader. And so now he's going to be our new projects contract supervisor come officially Saturday, but really Monday when he reports for work. So yeah, all good stuff. And so some good opportunities, but Patrick and I, as well as the other park staffs, are real excited to continue to grow the team, but then be able to provide awesome facilities for the public. So with that, I'm available for questions.
Thank you. So what you're saying is that wonderful new organization chart that we just received is obsolete.
It's always, that's the thing. It's always obsolete. Things are always changing, but then, yeah, we'll continue to update that for folks.
Thank you. Director Heffer.
Yeah, just a comment, that makes you the grizzled veteran of the department, doesn't it?
Believe it or not, I'm starting to feel like and Jim laughs at this when I say it, but I'm starting to feel like the aged person in the division. But I know that's not true, but I look at it as seasoned individual, which feels good. So thank you.
Thank you. Any questions? Okay, thank you for that. Okay, a Recreation Division report.
Thank you, Chair Nichols, members of the board. Couple fun things. I think I saw several of you at the flashlight egg hunt. Taxes are done. Thank you, Chuck, for all your work on that. CSVP had their volunteer luncheon today, which I saw several of you at also. Summer registration started on Monday. A little bit slow, nothing concerning, but I think it's because it's right before Easter and spring break. People kind of aren't in that mindset. So we're hoping to see it pick up after the spring break. We have about 40 kids who have received the Parker Bunny from going out to the different rec band events, and the rec band events are seeing about 100 participants or more now. So that's going on. And then James did a nice little form for you guys. We do it every after every registration. One of the 2 questions that we asked that were different this time was just looking at how many weeks people prefer a session to be, and it was very interesting, between 7 and 8 weeks. So, you know, really short little weeks is not what they like. And as far as the number of weeks without programming between sessions, they really like that to be pretty short. So 0, 1, or 2 weeks. So we are looking at the registration, and we'll be talking to staff over the next year or so in regards to programming and kind of maybe tightening some of that stuff up. And there's some real nice quotes down there that people wrote. People always actually write way more than any survey I've ever seen people write on. So, but with that, I'm available for questions.
Thank you. Any questions? Okay, thank you very much. Management Services, Ms. Smith.
Thank you, Chair and board members. I have no report, but I'm available for questions.
Okay, seeing none, we'll move on to our General Manager's report.
I'm surprised no one mentioned it, but tomorrow is Leadership Conejo. We're taking the chamber folks in a bus around the Conejo. It's always one of the fun days of the year. Saturday is a creek cleanup, Casca, Rotary. We're going to be working near the Arroyo Conejo off Hillcrest near Ventu up there as it kind of goes to where Rancho Conejo Park is. Candidly, it's where some unhoused folks have been living and, you know, been working on that. So there's plenty of opportunity to pick up some trash and stuff. So we're going to get for Earth Day, you know, group of maybe 40 or so folks down there on Saturday. Just as a reminder, gratitude circle. I don't know that I've said it publicly at a board meeting or anything, but the board has chosen former directors Ed Jones and George Lang to be the gratitude circle recipients. So on May 5th, that we'll be doing that. And with that, I'm available for questions.
Thank you. Any questions? Okay, thank you for that report. All right, next is director's reports and follow-up reports. I'll start to my left. Director Huffer.
Yeah, just the 2 items that were already mentioned, that the Easter egg hunt on, at Thousand Oaks Community Park. And it was nice that, they had just a small number of locations, but they were able to do much more. Uh, was it the year before where you had a bunch of little neighborhood parks and, I mean, it was convenient for people, but there wasn't much they could really do at those parks. And so to have the bigger groups doing the Easter egg hunt and having a jolly jump up and crafts and all the other things that were available for the kids was really nice. So I think that's it's a good compromise. I can remember some years ago where you had everybody at Conejo Creek South, and that was a bit of a disaster, I think. So little, I mean, there were some people who were having, as I recall, they had to wait like half hour, 45 minutes just to get in the door to do the event. So I think this is a great compromise with several of the bigger parks. So kudos to all the staff who were involved with that. And then we had the CSVP volunteer appreciation luncheon today. And despite the less than ideal weather, it was a nice event. And it's always amazing to see how many volunteers are involved in so many different activities. They have the name tags with what they were volunteering for. And, some of these I had heard of, but it was interesting to find out. And folks that I chatted to really enjoyed the event and enjoyed the food. I think particularly the donuts and the ice cream that seemed to be very popular. So, and then of course, tax season is done. I was hoping that I'd have the final numbers for this evening, but I didn't get a chance to finish those. But I'm fairly certain that we probably did more returns this year than we've done in years past. And by this last week, I was telling a couple of the folks here that for the last couple of weeks, we've been averaging about 60, 65 returns a day. On Monday, we zipped through 89 tax returns with 10 preparers at the facilities. So mostly satisfied customers. There were a couple who said, well, you owe several $1,000s, and for whatever reason, they weren't real happy about that. But I really enjoy the volunteers who work there and the clients had 99% satisfaction rate. So
Fantastic.
good program.
That's great. Yeah, thanks for doing that. Director Buss?
I don't have a whole lot to report. I will say that my mom has been doing the country line dancing beginning class at the senior center, and she really enjoys it. So they're doing great. And then my nieces have been doing the plays and absolutely love it. I have not been able to make one due to my children's events, but they've been absolutely loving it. And my mom tells me how great they are. So that the performances are really good. And then I went to the picnic today, and it is amazing when I walk up and I'm like, wow, there are so many people here. And I was late due to Rotary, but I was thinking that I was like, this is so amazing that all of these people have like a purpose to stay busy and active. And with seniors, loneliness is like a huge epidemic. And so I think that this community really does a great job at providing so many opportunities for people to get involved on all different little levels. You could run the chili cook-off, or you could just, join the knitting group, whatever your thing is. Doug, you can join the chili cook-off with me anytime.
I'd be happy to sample whatever chili you provide.
And that's all I have. Thanks.
Thank you. Director Orozco?
Thank you, Chair. So earlier this month, I did the Youth Leadership Summit that was hosted by the City of Thousand Oaks, and it was such an uplifting experience. I had an opportunity to sit with 3 different rounds of our youth, ranging from high school students to middle schoolers, and just genuinely blown away by the caliber of questions and insight and just enthusiasm from these young folks. Just with desire to improve their community and the suggestions that they have. So looking forward to future conversations with you guys about some of the things that were consistently brought up. And then I also attended on the 15th, so a couple days ago, the Latina GDP presentation at Oxnard College. That was really just interesting and insightful. And then later that evening, had my first opportunity to go to the All District Music Festival. So again, just like the youth, like they are amazing and wonderful, and it was so beautiful. I believe the high school that was performing was Thousand Oaks High School, and just like if you haven't had an opportunity for anybody watching, if anybody's watching, please go see them because it's so it was the strings that they were performing. And I'm looking forward to other future performances.
Thank you. Yeah, I was at the strings performance last night and thoroughly enjoyed it. Very impressed. I mean, even the elementary group was fantastic, but the middle school and high school, I mean, it was like I was at a full-blown concert. I mean, they were absolutely amazing. So yeah, very impressive. Thoroughly enjoyed it. And as I was the only VIP there. I kept saying, no, I'm not a VIP. I'm just sitting where the VIP section is, you know, just nothing special. But one of the staff, I guess you call them, that were there helping out, says, well, what organization with the park? Is like, oh, I love our parks. We have the best parks. Okay, great. That's fantastic. So we just continue to hear that. People love our parks. Our community loves our parks. And it's again, tell your staff that maintains the parks and your staff that provides the entertainment of the parks and your staff that provides the finances for the staff. Thank you for all that they do because our citizens love our parks. And I think that just speaks so well for our district in its entirety. On April 7th, was participating in a tour of this facility with Mikey Taylor. That was nice to do that. And then earlier this morning was at our CARPD Legislative Committee, then also at the luncheon today. As I was leaving the lunch, I was passing by one of our grounds crew out there, raking up all the leaves underneath the pepper tree, which is a daily occurrence. And so I struck up a conversation. His name is Merle. So you know him. And so I started talking to him. He says, oh, I love my job. He says, you know, I worked at Home Depot for 24 years. He says, and I've worked here for, I think maybe 3 years now. He says, I love this job. This is great. I think, wow, this is fantastic, you know. And then I hear tonight, Mike was at Pacific Sod. Now you've recruited a City of Thousand Oaks staff. I think we'll take them from wherever they're coming, you know. Get your training, come on over, you know. So if we can't start them in preschool, we'll take them from somewhere else. So that was just very encouraging to hear that again from one of our direct staff. Just happened to ask him a question. So thoroughly enjoyed that conversation. Okay, move on to item number 12, requests for status reports and items for subsequent agendas. Do we have any requests of anything? Okay. Next is items from the public. Do we have anybody late arrivals? We do not. And I understand that we do not have an executive closed session. Is that correct? So that brings us to adjournment. So we are adjourned.